Hey Shane, how's it going?
Kyle, it's a busy day, man. I'm back in the relationship management game, talking to clients and having conversations, and I don't know, trying not to do any financial planning because I'm a bit removed. That's like your bailiwick and Ken's, so trying not to step on any toes. But it's been kind of fun getting back into the mix of having some conversations with investors and hearing all their questions and concerns, and it's hopefully it'll help me write better commentaries and talk about more relevant things. It's been cool.
Awesome. We'll jump right into it today, but it's November 30th and excuse me, since we last spoke, markets rallied quite a bit, so we should have some good points to hit on here, but why don't we go ahead and take a look at last month's market commentary and just kind of highlight some points there.
Yeah, and we're a little late because last week was Thanksgiving, so we usually do these on the third Thursday or something like that. And
hmm
last Thursday was Thanksgiving, so hopefully everybody had a good Thanksgiving with family. And I don't know, I don't do the turkey thing, man. So we have lasagna usually, and not into turkey, not traditional.
Yeah, so perfect. Well, I think the big one, Shane, what was your biggest takeaway here on this commentary or point you wanted to introduce to everyone?
Well, I can actually say that this is a really great, well-written commentary because I didn't write it. I wrote a couple sentences and then turned it over to my one of my inspirations, Porter Stansberry. I think a very insightful analyst, and I would just encourage people to read it because we are in that moment where everybody's starting to call that the Fed successfully navigated its tightening cycle, and we're going to have a soft landing or no landing, or I, you know, well, I don't know, whatever they say. They say all these crazy things, but all through history, every time people have said this, they've been dead wrong, and there was a crisis right around the corner. So, I think history is important. It never repeats exactly, and but often rhymes and is very similar. I think Aldous Huxley's quote is, that men don't learn much from the lessons of history is the greatest lesson that history has to teach. So I think it's important to know what's happened in past tightening cycles and how they usually resolve. And the Fed usually ends up cutting rates in the middle of the next crisis that they've caused. So I don't know. Maybe this time it's different, but anybody who's been in the markets for a while knows that those are some pretty dangerous words, right? This time is different, and I missed it are probably the two most expensive statements to believe on the planet.
Yeah.
So yeah, mostly that's what's going on here is I think a pretty good narrative about, historical Fed tightening cycles, and I would encourage people to read it. But at the very bottom, if you scroll all the way down, um,
Let me just drop my annotation there. All right. And pretty lengthy one, so encourage everyone definitely give that a read. I think it is a great historical lesson. But
yeah, so these are, I mean, so I put some charts in at the end as kind of become our custom. If you want to just hit the 3-year moving average real quick, click the button, says view larger image, and should blow up a full screen deal. The 3-year moving average is not something a lot of people look at or watch, so I just thought this was a little bit interesting because I hadn't seen it out there before. Um, and so we broke below the 3-year moving average. Kind of like in 1973, it looks like since this was posted, I think we've probably bounced off that 3-year moving average. I personally don't know because I don't have that line on my charts. I'm sure you don't either. It's just not a very common one. I could add it, but I'm not going to right now. So anyway, I bet you we've bounced off of that. But you can see in the top left chart that happened in 1973 too. We bounced a couple times off the 3-year moving average before finally dipping below and accelerating to the downside. Looks like in 2008 that happened as well. A little bounce and kind of consolidation on the 3-year moving average, and then in 2000 to 2001 we got at least one bounce off of that 3-year moving average before dropping below. So there you go. I mean, if you read this as a good time to go short when you first saw this, when I wrote it at the beginning of November, maybe what the play was to play for that bounce, because that's what's probably unfolded since, and we'll see what happens from here. But until we get above that 1 month, or until we get above that downtrending red line, this one here, right?
Hmm.
I think what, these show boom, 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 down, boom, 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 down, boom, down. So this could easily go like this still, right? And that would be into the first half of 2024, which is sort of my base case. Not to scare everybody, but I take a look at the economy. It's awful. Um, Talked to a few guys last night in one of my groups, and it was like 30% of the people had more than 2 credit cards that were maxed out. All of them just maxed out credit cards, and people they just couldn't care any less. Like it's no big deal. I
Yeah,
never see anything like it, man.
the underlying fundamentals certainly don't look good. And I think you illustrate a great point here. We came down, we hit this line and bounced, and it's been a vicious bounce. So
Yeah.
it's from our last commentary. We've just rallied right back up here, and I bet we're sitting kind of right at this line, the red one coming down. But the key thing here is that if we are going to go lower, it's not just going to move in a straight line. And we've had this rally, but it's not a time to say all is well and just kind of disregard risk. You want to make sure you're still considering that. And really, until we hit a new all-time high at this point, we don't have that confirmation yet that this is a new bull market and all as well.
Definitely not. No confirmation that we're in a new bull market. We'll see that later in a SPY chart. Right, we're still in a bear market that started in November 2 years ago, 2021.
Yep. And then just one last little note on that. Usually the year before a presidential election does tend to be positive in the stock market. So
Mhm.
this doesn't predict what the next 10 years of returns are going to be. This is just, typically how it does play out before a presidential election. So,
Yeah, now we get into all the election cycle technicals. Woohoo.
yep, fun stuff. So, all right, well, I'll go ahead and
How would you even do a 3-year moving average? Because I always like they're always in days in my world. I don't think I could do a three. I don't know. Would I just have to do 365 times 3 and maybe use that as my day, or would I use trading days? How would you do that, Kyle? I'm curious.
I think on that one, it's you do it off trading days and
Yeah.
then you could just average it over, every day in 3 years. So it'd be what, roughly about 600 and some days um, of trading days, or you could just do an annual chart and use that one. You'd have 3 candlesticks. So many ways.
Yeah. Yeah, I don't think that would work very well. What do you think those are? You think those are weekly candles?
Those look like
It's gotta
weekly
be
candles
weekly.
to me.
Yeah, they gotta be weekly. All right, anyway, on to the next.
All right.
Now I want to see.
All right.
Yeah, quickly, the inflation isn't falling one. If you just launched that, I mean, inflation has actually bounced. This bozo Joe Biden just had a tweet talking about how people need to drop their prices because inflation is falling. I don't think he understands what inflation means. Because inflation of 4%, which is where we're currently at, and this is the headline inflation. The core inflation is over just a little over 4%, I think. Right.
Hmm.
Meanwhile, the core CPI is 4.1%. So that means prices are up by 4%. It doesn't mean prices have gone down. What was his tweet? You just posted it. What did he say?
I did. Gosh, I'd have to pull it right back up again here. Um,
It
let
was
me get
something
the.
really dumb. And the
It
shocking
was
thing is, it isn't even the dumbest thing he said
so
this month.
it said, "Let me be clear to any corporation that hasn't brought their prices back down, even as inflation has come down. It's time to stop the price gouging. Give American consumers a break."
I mean, what a perfect demonstration of a lack of understanding of what disinflation versus inflation versus deflation would be. He
Yeah.
says to
And
prices have not come back down. What kind of, you got to be on serious drugs to think that prices have come down. They haven't. They're just not going up by as much. 4% is the 4% increase in prices. That's less than 9%. It's less than 8%. It's less than 7%, but it's not negative percent.
yeah,
Price is still going up. This right here is called disinflation. This right here is called reflation. And so we're flat back to back for the past 2 months. I don't know what these, it's just either he's really smart or really stupid. I think he's probably doesn't understand what he's talking about. Um,
Yeah,
but
and I
it's just
think
shocking.
unfortunately, I think it's more they think that we Americans, the public, will accept that answer and believe that's how it works. But as most of us all know, inflation is created by printing way too much money, and it's not you and I that have control of that money printer. So,
It's shocking. It really is. It shocked me when you wrote, like, I was blown away that he said that. Anyway, we're nowhere near the 2% target, right? Because 4% is double the 2% target. Like, if I had told you 3 years ago that inflation would be 4% and you'd be happy about it, you'd have fallen out of your chair. Like,
mhm,
it's not good. That's a really high inflation rate by historical standards. So this guy's on drugs.
yep. So,
Anyway.
all right. Well, that's it for some of our charts down here or links. Any others you'd like to hit on, Shane?
Maybe the last one. Can't pay my credit card because I got a new one coming this month. So this one's pretty interesting. If you go look on Google Trends, the number of people searching for can't pay my credit card, as I just alluded to a minute ago, these guys are maxed out. They have no chance of ever paying this credit card debt off. None. It's never going to happen. And that's a whole bunch of other people too who are out shopping on Black Friday and putting things on buy now, pay later, and like they can't pay their credit cards. There's lots of other things they can't pay for too. So I'm gonna have another one of these Google Trend charts coming in my upcoming commentary. Maybe we'll get to that chart later today too. But there are others, and this is what I'm talking about. These kinds of things are not indicative of a an impending and imminent bull market. They're just
Yep.
not. If you can't pay your credit card off, the chances that you're going to be out there buying stocks are pretty slim. So,
And these, just so everyone knows, this is more of a forward-looking type indicator, right? Because the other one is have people, defaulted on their credit cards. And while we are seeing some of that come through, this is more people who've yet to default that are clearly worried about it.
yep.
All right, so those are kind of the key points there. And Shane, we created a new area on our website. What do you say we just hit on that real quick?
Let's do it, man.
All right, so for anyone new to our website, let's just go, if we were back at the home page. So you come here, there's two parts. One is if you're just curious in terms of, well, how do we manage the money? What types of strategies are available? You can click on clients here. Okay, why is that not coming up? Oh, so over here, sorry. So on the About tab, if you click on Strategies, all right. So you can
There it
go through,
is.
yep. So you can go through at this tab and look, core strategies, non-core. You click on Learn More, and you're going to see some of the, ins and outs of how those strategies work. So you get passive. And then the other one is just great for understanding some key concepts. Is if you go over here on resources, go to key concepts. This is great, just different ways of understanding, whether sequence or returns risk. We've talked about that one a fair amount. Just a great resource to come in here, kind of see what's going on there. So these are some of the numbers for, if you retire and you start off with some positive returns, it's going to tell you what your average return is and then how much money you end up in the end with, versus if the other scenario plays out and you start off with a negative return at the start, what does that look like overall? So, some different tools there, but certainly,
Can you zoom that in just a little bit?
there we go.
There you go. So what we're seeing here is that there's 20 years in both deals. But what happens is this year goes up to the top and this year goes down to the bottom. And so all we've done is reverse the order, the sequence of the way in which returns come, because of course we don't have any control over the sequence in which the returns show up in our portfolio. So it's the exact same average return of 5%. It's the exact same returns, just inverted. And it's the exact same starting value and exact same distribution amount. And on the left-hand side, you're taking out 5%, right? $50,000 out of a million, adjusted 3% higher for inflation every year. So the next year you take out 51,500 and 53 and 54 and 56 and so on. And at the end, you've still got $812,000 left over, and you've taken $1.3 million out of the portfolio. So that's pretty cool. I mean, it's a 5% rate of return, a 5% withdrawal rate with adjusted 3% higher for inflation every year. I mean, that's a pretty good retirement. If you retired at 65, you're now 85 years old, you still got 800 grand in the portfolio and you're taking 87,000 a year out. Not bad. But same scenario on the other side, you invert the returns and, by the time you get to, I guess it's year 15, that's it. You don't have enough money left over to satisfy your distribution, and after that, you get to move in with the kids and start eating cat food. So, the one thing we just don't have control over is the order in which the market gives us the returns. We have no idea if you retired in 2022 and the market was down 25% that year, and you had to take a withdrawal, right? Start with $1 million, you're down 25% to 750, plus you take out 50 grand. Well, now you only have 700 left when the market finally recovers. And as you can see, this person ran out of money before the market really kind of got going back to the upside. So sequence of returns, super important to retirement.
That it is. So encourage everyone, go check out those resources, some other helpful handouts there. But
And that's why everybody becomes an active investor once they retire. There's no such thing as passive investing during retirement, because now you need to actively take money out. You're not systematically putting money in, you're systematically taking money out. And at that point, passive investing is no longer a real thing. It's a lie. It's a lie that, the Edward Jones guy will get you to try and believe, so that you'll keep as much of your money in his portfolio being managed by him and paying a management fee for as long as possible. And so it's a big lie in the investment industry that there's such a thing as passive investing for people who are retired and depending on their portfolios for income.
Yep, that is true. So perfect. Well, with that, we'll go ahead and just kind of jump into our normal slide deck here. But yeah, starting off, here's the S&P 500.
Hold on one sec. And there are other resources that Kyle didn't go through. So I would encourage y'all to go back to that website. And there's a whole bunch of others that you can click through. And if you have questions on them, feel free to give us a call and ask us to walk you through them. Be happy to do it anytime. So
Yep.
it's the resources, key concepts section of our website. Some good stuff about risk and reward in there, and the efficient frontier for passive investors, which we don't typically recommend, but we do offer some passive strategies for people who want that. Sometimes we just can't talk them out of it. Nothing I can do about it. So, hey, you want a blue shoe? I'll sell you the blue shoe, I guess.
Yep.
But anyway, yeah, this is the S&P 500. I did do a quick look at weekly candles with a 156 period, which is, 3 years worth of weeks, right? 52 times 3, 156. That's what the 3-year moving average would be on a weekly chart. So anyway, I figured that out, and it has bounced above the trend line, by the way, just like this looks. So interesting.
Perfect. And here we are, and you'll see we have this, temporary high that was put in back there. And
oh
now,
man, I got the percents on there. I don't have the prices on there. That's a bummer. My bad.
Well, this line, is this our 4th time testing it? It doesn't mean that just because we might be rolling over here a little bit that this is the top, but it is a point of interest here that it's hit 4 times, and we'll see how the year finishes. But right now, we'll see. That's going to be a tough line to break, I think.
And that line is basically, let's see, the number is 4,000, like 570 or 457 if you're looking at SPY. So that's about where it is, 457. So that has held as resistance, like you said, 4 times now, and we'll see if it can go. We'll see if it makes it another time. I don't know. To me, it looks like it. I think that's a good short entry point right there, with a stop right around this 457 area. If it goes above and breaks out, cool. But as you can see, this was the high back in December of 21. And I guess it was the Nasdaq that put in its high in November of 21. The S&P 500, I guess, rallied into the end of the year, but we're still down from there. So definitely not in a bull market by my definition.
Hmm. So yeah, we'll see how it handles that line, and then we still have that all-time high to take out. So we'll
Good
see.
luck with that.
And here's the big one. So Shane, inflation expectations, they're going up. How does that, there's two parts that I see is that one, how does that impact just overall, market behavior? And then secondly, how does it impact the consumer?
Yeah, well, if you go back and listen to what the Federal Reserve Chair has been saying, is that he doesn't want inflation expectations to become entrenched. Well, he sees the same data we do. This looks like it's becoming pretty entrenched to me. So I don't, that's why they keep hiking rates. They need inflation to come down because the longer people expect inflation to be going up like this, the more inflation will go up. It's kind of like a self-fulfilling prophecy. And it is not going to be like if you expect everything to cost more and more and more, you're gonna have poor sentiment. It might cause you to go out and buy more things in the near term before prices go up, but then you've overextended yourself to be able to deal with further price increases in necessities like food and gas and energy and utilities and things like that. And that's where people end up filing for bankruptcy and getting foreclosed on, and none of that's good for the economy. So, for a lot of reasons, they need to get these expectations way back down into the twos, and they're so far not succeeding despite their pretty historic hiking effort. Um, so I don't know how you could look at this and pause, but that's what they've been doing, and that's what the market's expecting them to do in December. And now the market's expecting them to cut rates in 2024, which I don't think is even the only way I see that happening is if we're in a recession and the market is crashing. So
Yep,
they're begging for this cut without you know without knowing what has to happen for it to arrive. It's just it's crazy.
agreed. It's not one of those where you look at it and go, oh, they cut rates. That's wonderful for the stock market. Things are good. That is typically in a situation where things have gotten bad enough where now
Yeah.
the Fed tries to be accommodative.
Yeah, it's almost like Wall Street's rooting for people to lose their jobs so that there will be a cut in interest rates. It's like people losing their jobs is not good for the economy. I don't care if it leads to a cut in interest rates. Like, and once the market realizes that is when it really sells off. Like they're
Yep.
just delusional right now. It's crazy.
So then the other one, consumer sentiment. I always think this is a big one because again, it's a forward expectation, but how do people feel about where things are? And here we are at a lower number again too.
Yeah,
Um,
well, it's just the inverse of the inflation, right? So
mhm.
inflation goes up, inflation expectations go up, and sentiment declines. And when sentiment's bad, it leads to less spending in the economy for consumer things. So especially discretionary items. So like I would not have wanted to be long consumer discretionary stocks, like with the exception of maybe Amazon, all year because it's not going well.
Yep. And then this is a big one. So the interest payments on US debt, it's going way up. That's this huge number. How does the normal person even comprehend what this means?
You can't. You simply can't. I mean, there's no way to comprehend. It's incomprehensible. Like, period. I don't know how to contextualize this. The level of that spike in interest payments to over $1 trillion of interest payments alone is absolutely insane. And this is the only reason we haven't been in a recession all year is because the government has borrowed so much money and spent it on things in an effort to keep GDP from declining. And so they've succeeded in the short run of preventing that recession from officially taking place, but at the expense of this, which is just like who could afford $1 trillion? We're bankrupt already. Our government is totally insolvent. There's zero chance that we could actually afford $1 trillion a year in interest payments. Like that doesn't even pay down the balance of $33 trillion. And that $33 trillion balance doesn't include any future expense for Social Security or Medicare.
Yeah. So, and I think when you look at it, so my takeaway is, excuse me, well, how do you combat this? And I see two alternatives. One, the government starts cutting down on spending. and manages things, like Dave Ramsey might advise. I don't see them doing that. That's going to anger a lot of people. That's not going to win an election. Um, or you print a lot of money and keep paying it with printed dollars. So I don't know, Shane, do you have any other perspective on that?
We'll get this. Here's how you can try to contextualize. Like it's still incomprehensible, okay? But do you know how many days? I'll give you a hint. It's days. 1,000,000 seconds is
Days. Gosh, I couldn't even, what,
it's 11.
500,000?
No, it's 11
Eh,
days. Okay.
Okay.
1,000,000 seconds is 11 days. 1,000,000,000 seconds. How long do you think that is? Do you think it's measured in years or days or weeks or what?
Year and a half.
1 billion. Okay. 1,000,000. This is crazy. It blew my mind the first time I heard this analogy as well. But this is real. You can go into Google and type this in. So we said 1,000,000 seconds is 11 days. 1 billion seconds is 31.7 years. 31.7 years in 1 billion seconds. So from 11 days to 31 years, that's the difference between 1,000,000 and 1 billion, just for some context. So how long do you think 1 trillion seconds is? How many years do you think 1 trillion seconds is?
Oh gosh. Now you're probably talking, what, 500 years? No, let's go with 1,000.
31,709.
Yeah, that's a big number.
31,000 years is 1 trillion seconds. And we are going to spend $1 trillion every year on interest only. Dude, it's incomprehensible. You can't
That it is.
understand a timeline of 31,000 years. We're going to live like 100 if we're lucky. 31,000 years. You got to spend $1 every second for 31,000 years. Think about that. Dude, it's incomprehensible. We're never paying this money back. It's
Nope.
never going to happen.
And then here we are. So Shane, I think this one's different than paying your debt. This is
Yeah.
actually, well, how do you get rid of that car that has
Yeah.
the debt?
I can't. So we're at an all-time high, including the great financial crisis for can't pay my credit card. And we are at a way, like it spiked by double its previous high to give car back. So I can't pay my credit card and now I want to give my car back. You know how you do that? You just leave the keys in it in your driveway and the repo guy will come and pick it up for you. That's how you give your car back. Just in case anybody is wondering how that happens. That's how you do it.
Hopefully not too many of our listeners. I know that's an unfortunate circumstance to live through.
Oh, dude,
Um,
I'm sorry. I don't even mean to joke about it because it really is like real people are absolutely getting killed. I mean, I have plenty of family members who, you know, let's not do Christmas this year. It's heartbreaking, man. And it's all like self-inflicted wounds.
yep.
Our economy cannot afford our government, and people need to remember that when they vote.
And then here's the big one. This is, Dave Ramsey was always famous for this one. Go around and ask people, if you had an emergency expense, how can you pay for it? Right now, $2,000 emergency expense doesn't look like a lot of people have the necessary means to be able to pay that. And that's a scary situation.
Nope, it's just getting worse and worse.
And then here, so artificial intelligence really changing the topic here now. This is the big one, right? Because NVIDIA, AMD, all those stocks can go to infinity with AI, right? And everyone's starting to see this big pie in the sky idea.
It's pretty amazing. I mean, it's really pretty amazing that there are this many weekly news stories about artificial intelligence. And then because of what happened last week with OpenAI firing its CEO, and then the CEO getting his job back, and the whole board getting, what's the word? Shuffled, I guess.
Mhm.
Adding Microsoft to the board, bringing Larry Summers on the board. It's all very strange, man, but there were a lot. I mean, I did like doubled the number of articles in a week, and it was already like obscenely high. There are more articles about artificial intelligence than there are about, war in Israel or Ukraine or national debt, or it's like it's the most trending news topic there is, and it's supporting, the entire stock market is on the back of this AI hype. And it's all just straight up hype.
Yep.
Um, so it's not, and AI is not even a new thing, as I've written about before. The AI, artificial intelligence, has been around longer than the internet, and I think you can read like my April commentary if you want the data on that. I think it's April.
Yep. And then here's a big one. So government spending. This is one that, when you've seen some of the labor market be resilient and some of these, I think GDP numbers hang in there. Well, it's who's spending it, private or government.
Yeah.
And right now it looks like the government's spending a little more.
The
And
government has really stepped up its spending on structures and things. So like the black line is government structures. Think about that. Like is anybody else in the world buying office space right now other than Uncle Sam? I don't think so. You know, so like, and I honestly, I haven't dug into what structures is, and I don't know if it includes like infrastructure, like bridges and tunnels and roads. I don't know. I really don't know. Um, but it's a lot more spending than in 2021 on a percent change basis, and this is what has kept GDP from going negative in large part. So,
yep,
well, that and all the credit card spending from consumers, on the money, and the buy now pay later spending. It's pretty wild. Everybody's spending money they don't have though, because the government does not have this money. They print it and then are astonished that there's inflation. It's like, guys, stop printing money and the inflation will go away. It's pretty simple.
yep. And then here's the big one is the Fed. They can attack demand and lower that. And how do they do that? By creating unemployment. And it looks like that's finally starting to tick up a little bit more. Is that the correct interpretation, Shane?
Yeah, well, I mean, this data is fresh out this morning, and you can see if you look close enough that like, you know, it was way down here. This is in what, millions of people, I think. 1.9 million people. I think that's right. Is that right? Does it say at the bottom? I got stuff on my screen I can't see.
And
I think that's millions of people. I could be wrong, but I think that's millions. And so I mean, that's a lot more. That's like 25% more people, And we had a peak, and now we've got a, that's what you would expect just based on technical analysis, is that's a breakout in a bad thing.
yep,
And Wall Street wants to look at that and say, well, geez, then the Fed might not hike rates anymore. So it must be good that people are losing their jobs, because then the Fed won't hike rates anymore. Once they realize that it's actually not good for the economy, that this many people are remaining unemployed for an extended period of time, that's when reality sets in and everybody's on the wrong side and they all go rushing for the exits, and the market drops very quickly. So this is something to keep an eye on. You never know. It could be an anomaly. It could just be a 1 month anomaly, and maybe it ticks back down from here. It's always possible. I don't know. I do have a crystal ball, actually, believe it or not. My wife bought me one. Um, Unfortunately, it does not tell me the future. So
yeah, and it's a hard one. These are numbers that we are putting a trend in from September of claims going up, but hard to know what the next one's going to be. We're not economists, and even economists don't always get it right.
I mean,
So
I think this trend's intact from at least back here though in 2021.
yeah,
It's still up and to the right. Yeah, there is a little bit of a downtick, in 2023. But overall, I think the trend is higher over the past couple of years. And I don't know. I mean, we lost an employee, and one of our new employees who was with us for a few months. He got paid to learn a few things and then bounced. And we decided at Elevate that the economic environment is not supportive of us rehiring for that position. So that's part of the reason that I'm back on the phone talking to clients again, is because we just decided, hey, we're going to work a little harder rather than go look for another employee. So that's happening across the board. Like,
yep.
people stop hiring and stop paying overtime before they start outright cutting people. So
And that's that sentiment number, right? So if sentiment's positive, then there's hope for the future. Companies will go out and hire because they're planning for good times. But when they're not planning for good times, they find other ways to cut costs.
Yep. And I guess that brings us to our final our final slide of the day,
Yep.
which is hilarious. $33 trillion of national debt. Now, remember, what did we say? How many thousand was it? How many thousands of years did we say a trillion seconds was?
I will leave it up to you on that one.
What did we say? We just said it. It was like 30, was it
I want to
31,000
say like
years? Yeah, 31, yeah, it was
30,000.
31,000 years. So if we did 33 trillion seconds, it should be 33 times greater. So that's oh my, 1,046,423 years. We're gonna spend $1 a second for 1,000,000 years to pay this off. Guys, this debt's never getting paid back. Ever. Nope. Certainly not with today's dollars. The only way to pay this money back is to print $33 trillion. And if you print $33 trillion, you don't even want to know what the inflation percent rate will be. I don't even know how to guess. It would be 100%, 200%, certainly in hyperinflationary mode. I don't know, over 100% inflation.
Yep. And this is a problem that has happened throughout history with other, world powers. So you can go back, look at some of the historical stories on that, but
not just with not just with a few of them, with every single one, every single superpower through history that has had the world reserve currency status has eventually found themselves in this position, and then the rest of the world decides like, I don't think I want those. I don't think I want that currency. And then there's a massive shift that takes place. It doesn't end the world, right? Like it's happened in our lifetimes. Maybe not yours and mine, Kyle, but for some people, they were around when like the pound sterling was the primary thing.
Mm-hmm.
You know what I mean? And one day they woke up in Great Britain and the pound sterling was no longer the favored currency, and everybody was like 30% less wealthy overnight. The dollars and the pounds in their account were worth, they bought 33% less stuff overnight.
Yep.
And there was nothing anybody could do about it. But, didn't wipe Great Britain off the face of the planet. Like you can still go to London, still people there. So it's not like it's the end of the world when we say this stuff, but like you look back through history, again, it's a good teacher. I don't know. I don't know how long this can go on for. It can go on for a while longer. It always can. But there's a reckoning somewhere down the line. I think I'll be alive to see it.
Yep, I would agree with you on that statement. So we'll see. But Shane, thanks again for taking the time to sit here with me and walk through some of these, different things we're seeing, kind of what we're thinking in the market. But interesting dynamics out there going into the last month of the year. Santa Claus rally, maybe, or
Maybe
something else. We'll see.
Yeah. All right, guys. Thanks for tuning in, and please do send us questions. Helps us prepare for these things, and the more questions we get, the better the content will be. So send questions to info@elevatecapitaladvisors.com. You can also send them to Kyle or myself if you have our email address. But again, that's info@elevatecapitaladvisors.com. Kyle can put that in the notes down there, so it's easy for you to send us an email, and we'd love to hear your questions.
Yep. So awesome. Well, thanks, Shane, and I'll see you next time.
Later, buddy.